Alejandro, good evening. My name is Philippe Maupin. I'm very honored to moderate today's webinar, which I will introduce with 3 words. The first one is transitory. When Federal Reserve Chair Jerome Powell used the word in summer 21, there was some head scratching in the US, as apparently not everybody knew what it meant. According to the Merriam-Webster dictionary, is transitory something of brief duration, not persistent. The adjective applies, of course, to the ugly beast of high inflation, a thing of the past that we all thought of as dead and buried since Paul Volcker defeated it in the 1980s. Transitory or not, I do not know. The second one is Article 16, which is the ultimate nuclear weapon in the post-Brexit drama that is currently taking place between the UK and the EU. Will Boris Johnson press the button? Will the French send Navy ships to Jersey, or will they cut power supply? I don't know. The third one is uncertainty. Even though I don't recall having ever lived in a world of certainty, it's true that it's close to impossible to guess what the world after the pandemic will look like. Will we work permanently from home or go back to the office? Will we fly again? Should we pursue careers in finance, sweat for hundreds of hours to master the CFA curriculum, when there are many open, well-paid openings for lorry drivers? I do not know. I even have a 4th keyword, which is the ticker of an ETF that launched yesterday in the US, BITO, but let's save that one for the Q&A session. Jens Weidmans, the president of the Deutsche Bundesbank, was kind enough to wait until our webinar to announce that he will step down at the end of the year, 5 years before the end of his term. In his message to the staff, he stated the following: "It will be crucial not to look one-sidedly at deflationary risks, but not to lose sight of prospective inflationary dangers either." The speakers tonight will have to answer tough questions. Blue, Erik, the floor is yours.
All right, thank you, Philippe. Well, we'll start with the inflation topic, but first I do have to warn you, next slide, that being part of an exchange, CME group, Erik and I are not supposed to give investment advice. But if you accidentally hear any, just remember that it was free and it came from an economist. Okay, let's move on to the topic of inflation. We're going to talk about whether it's transitory, supply side, so forth. But before we do that, let's take a quick poll. What's your view on inflation? Is it going to be low? Kind of close to the 2% target, above the 2% target, or really a big problem? So you have 4 choices. If you could fill in the circle and then hit submit. And this is inflation for the Eurozone. Are we ready to roll? If you haven't submitted, click any one of them and hit submit. Then let's go on to the next slide. So we have a good bit of inflation in the United States, over 5%. The Eurozone's running at 4%. Japan has no inflation. What's new? Next slide. There's still some inflation in Europe. France is not too much yet, but hang on. Germany a little more, and of course the UK is leading the pack. Next slide. One of the things that people talk about is supply side, supply chain inflation. The poster child for that is shipping costs. We have 3 lines here. They're all going up. The Baltic Dry Shipping Index in the middle. The Panamax is if you want to send something through the Panama Canal in a ship that's really too big for it. There's very little room on either side of the canal. No mistakes there, like say that happened in the Suez. And the real big Cape size, but they're all going up. Next slide. This is a U.S. one, but you know, the U.S. buys a lot of goods from China, and so that top line shows the increase in the cost of shipping a 40-foot container from Shanghai to Los Angeles. It's cost more to ship it back too. Even if it goes back empty, you have to get it back before you can fill it up with goods and ship it again. So supply side constraints are pretty important here in causing inflation. Next slide. One thing we know is that the path of inflation is going to be very hard to figure out. Again, this is the US inflation rate, but if you assume that we're on a 5% inflation path versus maybe a 2% inflation path, you're really not going to know until middle of next year if you're following the data. Both of the paths with year-over-year inflation are likely to rise a little more before we start to figure out what's going on. We think we'll see some of the same patterns develop in other countries where we're just really not going to know for 6 to 12 more months if all you're depending on is the data. Next. Big question, of course, is what are central banks going to do? This chart shows the assets of the central bank as a percent of their economy. The Bank of Japan has already really started their own taper. They've stopped buying equities, at least temporarily. The ECB has told us that they are definitely not tapering. They're only recalibrating. I'm not sure of the difference, but we'll find out. And the Fed is expected to announce on November 3rd that it is going to start its asset tapering and be done with it by June of next year, but they're not going to even think about raising interest rates till they finish with the quantitative easing program. We'll see. Next. Commodity prices are a big influence on inflation expectations, and commodity prices have basically doubled from their low points at the pandemic. So a lot of action there, particularly in oil, natural gas, a few other, the energy sector. Next. So that's really the implications for inflation. We'll all be following what it does to the euro versus the US dollar, which has been in what I would call a trading range, but 115 to 120. And it really, depends on who goes first and how much they go by and so forth. So we'll see how that goes. But that's the introduction to the inflation topic. And I guess I'll start off with the point that I care the most about. If the inflation is really supply driven, which I believe maybe accounts for 80% of the inflation we're seeing. By the way, I think it's transient. It's just that my definition of transient is 3 years. So it might not fit your definition. But the main point here for me is that monetary and fiscal policy are not capable of dealing with this kind of inflation. If the inflation is coming from the supply side and you raise interest rates, well, sure, you can lower demand, but do you really want to do that coming out of a pandemic? I don't think so. So I'm afraid that this inflation is a totally different game than we've seen in the past. Erik, I know you've got some interesting views on what's been going on in inflation role as well.
Right. So I think that there's, to me, there's sort of a question of why, and then there's a question of what happens next. So I think the question of why is really interesting. Why did it strike first in the United States? In the US, we had this 10% annualized rate of inflation in Q2. Things kind of calmed down in Q3, but there are certain components of inflation that are starting to ramp up. And I think in a nutshell, it really comes down to the size of the fiscal stimulus. In Europe, budget deficits went from about 1% of GDP before the pandemic to around 10%. In the US, it went from 5% of GDP to around 20%. So US fiscal stimulus is just so much bigger than everyone else. And you really see this when you look at the consumer spending numbers. You look at the consumer spending numbers in Europe, they've come back up to their trend that they were at before the pandemic. The US, because they sent thousands of dollars worth of checks to almost every American family, as well as enhanced unemployment benefits, managed to kick consumer spending into the stratosphere. I mean, just way higher than it had been previously. So I think the question in the US is what happens next? The government's now removing all this fiscal stimulus. The job market's recovering, but it's not recovering entirely. So does that relieve the inflationary pressure, or do we see this huge ramp up in housing costs now? I mean, housing is something like 1/3 of the CPI index. Does that put this huge upward pressure on inflation going forward? But then there's also one even bigger question. And a bigger question is what happens in Europe and Asia. Up until now, European and Asian inflation rates in Japan, Korea, China, the Eurozone have been relatively tame compared to the US, especially if you look at the core numbers. The European headline, of course, is a bit high now because of commodity prices. But now you have this 300% rise in coal prices, 500% rise in natural gas. And so this is obviously going to kick home heating cost and electrical cost to the stratosphere. But it could go a lot further than that too. When you look at the cost of manufactured goods in Europe and Asia, on average, natural gas in a direct sense is 3% of the cost. When you look at electrical costs, it's 7% of the cost. And the electricity across Europe and Asia is generated in large part from coal and from natural gas, with some solar, nuclear, and other things mixed in. So when you think that 10% of the cost of manufacturing goods comes from energy, and then suddenly you triple or quadruple or quintuple the price of energy, that could really put a lot of upward pressure on more than just energy prices, on the prices of all sorts of manufactured goods. It's of course important because Europe and Asia together are responsible for about 75% of global manufacturing. So you could be looking at potentially big feed-throughs of consumer prices if coal and natural gas prices don't sort of go back to normal in a pretty big hurry here.
Yeah, Erik, that's really fascinating me because what you're I guess if I kind of boil that down, what you're saying is that they're going to be big political issues. I mean, if I look at take China, they've been able to have a pretty stable currency during all of this. But one reason might be that they want to manage it so if they let their currency get weaker with their economy weakening, then their commodity prices would go up for imports. So they don't want that. And then in Europe, I can't imagine. I can imagine actually that energy costs are going to be a big debate. Like, say, I think there's an election next spring somewhere. We're going to be talking about that. And then in the U.S., we've kind of settled our election for a while, but the Federal Reserve you see today will not be the Federal Reserve that makes the decisions. President Biden gets to appoint somebody to replace Janet Yellen. That was never done. He gets to decide whether or not to name a new chairman. And, we don't know what he's going to do, but it's a big decision. He gets to decide two different vice chairmen. We're going to get two different presidents of regional feds. So the Federal Reserve Open Market Committee is going to have a very different membership when the topic of interest rate increases comes up next summer. And we really don't know which way it's going. But the read I'm getting out of Washington is that the Biden appointees will be more interested in bank regulation. But on the monetary policy side, they're going to be thinking about what we call going to neutral. And their definition of neutral, well, it's not published or anything, but my definition of their definition is that they would like to see the Fed funds rate approximately equal to their inflation target. So they don't have to get there too fast, but they might be going to a 2% interest rate instead of 0, because going to neutral means you're declaring victory in the sense that the economy no longer needs to be on emergency life support. It doesn't need to be in intensive care. So removing quantitative easing, putting interest rates at neutral, would allow the president to say, hey, the Federal Reserve doesn't think we need help anymore. We're in good shape. So a lot of changes coming.
Yes, I think Emmanuel Macron is thanking his lucky stars right now that France gets about 3/4 of its energy from nuclear.
Correct, but
Yes,
let's
really.
not forget that the yellow vest movement was sparked by the increase in gas price, and it's never been as expensive as today to fill up your car. So let's keep our fingers crossed and hope that it won't start again. But it could.
Yeah, anything that has to do with food or transportation is going to be a political hot button, that's for sure.
Yeah, and the other thing is the other big re-election next year is Xi Jinping. I know we wouldn't normally call it a re-election, you might call it a reselection. But he's starting to face a lot of pushback in China from his idea of doing property taxes. There are actually forces in China standing up to him and saying no. And this could get really interesting in light of the fact that China now has these rolling electrical blackouts, which, by the way, are intensifying those supply chain disruptions around the world. And now China is facing tremendously higher costs for electricity going into winter. This could be a very interesting period for them too.
Yeah, we might talk a little bit about inflation expectations here. The markets seem to be incredibly complacent about what's going on. I mean, in the U.S., the 10-year Treasury is yield, at 1.65 or so, is clearly not all that worried about inflation. Now, the Fed's still buying 80 billion of these things every month, so that's part of the problem, or part of why you don't get the price discovery. But you're still on the 10-year boons in Germany. There's still a negative yield. So I mean, that's just very inconsistent with worrying about inflation. When I talk to my friends in the equity markets, they're a lot more worried about inflation than my friends in the bond market. Although history has shown that my bond market friends might be slightly smarter. I don't know. We'll see.
Speaking of inflation expectations, Jeremy Rudd of the Federal Reserve Bank recently published a paper entitled "Why Do We Think That Inflation Expectations Matter for Inflation, and Should We?" And his answer is no, we should not. And he reviews the relevant literature, and he suggests that the belief that inflation rests on expectation is extremely shaky. And he makes the case that adhering to this belief could easily lead to serious policy errors. Do you have any view on that?
I think it's interesting, but my question about it is this. So we've been in this period now for, I don't know, decades of falling inflation or low and stable inflation since 1994. So there's not really a lot of data to go off of in the last quarter century. We actually have a rise in inflation. My question about it is this: now that we have these incredibly high savings rates coming out of the pandemic and this huge increase in household wealth, what happens if people do come to believe that prices are going to be higher for a lot of consumer items in the future? Do they rush out and spend all of this money quickly? I don't know.
Yeah, I think that's right. But I take a little longer view. And, when we've had inflation, we've learned that it's very hard to stop. And when we haven't had inflation, we've actually learned that it's nearly impossible to get it going again. And so I think inflationary expectations get embedded a little later on in the game, and then they magnify whatever's happening. So I don't think inflationary expectations are going to cause inflation, but I think once we have inflation, they make it harder to stop. And then on the other side, when you don't have inflation and you're a central bank and you're pulling every stop out you can think of to create inflation, if people aren't, you can't do it. You've got a big headwind against you. But the pandemic, of course, has really shaken up everything in that logic. So there's no question that we have inflation, but now we're arguing whether it's supply driven or transitory. And I buy, as I mentioned, I buy the supply driven argument. It's just that I don't think it goes away very quickly. These are very serious issues, and they feed all over the economy. But inflation expectations might get a jolt somewhere along the line here, but we'll see that in the bond market. It just hasn't happened yet. Now, Philippe, do you want to go on to the next topic?
Yeah, let's move on to Brexit and the unintended consequences thereof.
Yes, well, it certainly is interesting living here in the United Kingdom and experiencing Brexit in my own limited way as somebody in London. You go into supermarkets and the shelves are not completely full. Sometimes it's difficult to find things. I actually don't own a car. I've been spending the last quarter century living in Manhattan, Paris, and central London, so I never really felt the need to own one. But all of my friends who own them were complaining a few weeks ago about the incredible lack of petrol. And so it's been a very strange thing. But let's begin though with a little survey here on the In the post-Brexit era, will the Eurozone gain an advantage and be able to increase its market share of financial service jobs in London by 2023? So you see there's three options here. And just hit whichever one you like and submit, and we'll take a look at the results at the end. Okay, I know how I'm voting. All right, so while you all are voting, why don't we just go on to talk about a few charts on the next few items. One thing I think is kind of interesting here is that the British pound basically collapsed at the time of the Brexit referendum. It hit bottom about 3 months after the Brexit referendum versus the euro, and then since then it just went nowhere for the next several years. It's been kind of trading in this range versus the euro from maybe 1.05 to about 1.2. It's kind of near the higher end of that range right now. But if you look at this next chart, you can see that it also fell versus the dollar. But of course, the British pound also is quite connected to the euro when you look at it versus the pound. I think of the Europe as being the eurozone rather as being kind of like the sun in the solar system, whereas the British pound is like the largest planet, the Jupiter, and it kind of orbits in a somewhat eccentric orbit around the euro. So it tends to do what the euro does, but with some variation, and has also been fairly weak. What I think is interesting though for Britain is that when the Brexit referendum passed, the currency crashed, which was helpful to British exports in the short term. That really boosted British exports for a few years. And it made London super competitive in terms of its costs. If you were a foreign employer and you employed staff here in London, it was great. But for the subsequent really 4.5 years after the referendum, up until December 31, 2020, Britain was in every sense a member of still a member of the EU. It was leaving, but it still had all the advantages. It's only in these past 10 months that it's really outside of the fold. And you're starting to see the consequences of that. If you go on to the next slide, I think one of the really big slides that everybody just suddenly woke up to in January was that the cost of exporting goods to Europe suddenly became a lot higher. If you were a British company and you were exporting goods to the euro area pre-Brexit, on average, including really basic stuff like invoicing and making payments, it took on average 7 administrative steps to sell your goods from Britain to Europe. Suddenly, as of January 1st, it takes 39 steps. And so there are really big companies in Britain that have the administrative staff, the lawyers, the compliance officers, et cetera, to fill in all of the necessary documents. For them, it's an added expense, but they can do it. But it's really the small and mid-sized enterprises in the UK that are being crushed by Brexit. Ironically, these are a lot of the same people whose workers voted for Brexit, but that's another story. But they are, the UK companies, I think, are also sort of realizing now the extent to which they depended on foreign workers, and the shortage of gasoline and petrol, diesel fuel and other things was sort of symbolic of their dependence on foreign workers. But a lot of British businesses have underinvested in CapEx. So they don't really have the most efficient processes because they were so reliant on inexpensive labor coming in from Poland, from Romania, Bulgaria, primarily countries in Eastern Europe. And then, of course, with respect to the financial sector, now that we've all voted, my experience of being in London is that some jobs have already left to Dublin, to Paris, to Luxembourg, Amsterdam, and to Frankfurt. Some also even outside of the Euro area to Zurich, Geneva, and even a few as far away as New York or Singapore or Dubai. So London, may be losing a little bit of its financial center, but not necessarily too much. I think we maybe have one more chart on the whole Brexit issue. And that's it. This chart I think is a very short-term chart. The chart I personally like better, I regret not having put it in the deck, is that from 2010 to 2015, the UK had the fastest growing economy in Europe. Since the referendum, the UK has had the slowest growing economy in Europe, or at least one of the slowest, right down there with Italy. So it looks like the uncertainty created by Brexit has really weighed on the economy. And so I guess the question going forward is, does it continue to weigh or not?
Yeah, I mean, there's a lot
Do you
of
have an answer to that
uncertainty.
question, or do you have views?
Yeah, I see a lot of uncertainty in the UK and no real way forward. I mean, one of the things that they haven't solved at all, of course, is Northern Ireland. And it's a big contention. And I think one of the things that's not always being factored in with how the UK and the European Union solved Northern Ireland is the US role in that. The US is tremendously committed to the current situation in terms of the peace treaty that was negotiated a number of decades back. And they don't want any change in that. They want to make sure there's an open border. And so the UK in its negotiating has to really think about its relationship with the US. There's a kind of a shadow third party in how the European Union and the UK deal with Northern Ireland, and I think the US is going to be unusually vocal on this topic. So it's going to be a very interesting debate. Another topic. Go ahead, Erik.
I was going to say, the Biden administration seems very, very sympathetic to Ireland, given President Biden's Irish ancestry and origins. He doesn't seem to be necessarily too favorable to the British on that particular question.
Yeah, another issue that back in 2016, when we had the Brexit referendum, it was a real learning experience for me about ways to analyze markets. You were going into the referendum, which was, I think, June 23rd, 2016, and you really knew that if the UK voted to remain, the pound was going to take off to the upside, and if they voted to leave, the pound was going to drop. But you didn't know which way it was going. And watching the results of the referendum, it took 4 or 5 hours to figure out which way it was going, and then boom, the pound made its move, down 7% in a very short period of time on that Friday the 24th. And so we did some research, and we decided that in these kinds of cases of event risk, there's a period of time where before the event occurs, where you have a very bifurcated risk profile. Could be one or the other. By the way, that's, for you statisticians, that's a bimodal distribution. And if you depend a lot on implied volatility, you're never going to see that because that embeds a normality assumption. So we've done a lot of work to try to understand when these things occur. But then as they occur, as you get the answer and the outcome, you have this period of huge volatility and uncertainty followed by, okay, now I know. And then you rebalance. So it's a very interesting market impact. And it all occurs in a really short period of time. So it's these kind of event risk episodes have dramatically influenced how I do my research on options and things like this. So we're getting prepared for a whole bunch of these things coming in the next couple of years.
Right, let's move into the post-COVID world now.
Yeah, so and for the pandemic topic, we have 3 questions, and they all revolve around your business travel. I don't know about many of you, but I have definitely had my attitudes been affected. So the question is, for the year 2022, are you taking any business travel that would be transcontinental? Look, I know you're going to go skiing and stuff like that, but the question really is, are you going to take a business trip to another continent? So you have to be on a plane, 8 or 9 hours. That's a whole nother story. And then you might have to take some tests when you get there, some tests before you get there. And so the question is, are you going to take any trips at all? Are you going to take some trips, but not as many as before the pandemic? Or are you going to take a lot of trips because you realize that all your clients haven't seen you in a long time and you better get there first because it's going to be important? So let's vote on how many trips you're going to take. And then after this, when we get the answer, we'll know whether to bet on jet fuel going up or down. Okay. While you answer that question, let's go to the next slide. One of the things that is, we've done research on the pandemic. It's taken me in the direction of thinking more and more about complex systems. But then I talk to people about it and they say, well, you know, it's all very complicated. Well, you know, some complicated things like, say, space tourism or driverless vehicle, once you figure it out, and I don't want to underestimate how hard that is, but once they get it right, it's very predictable. It's very reliable. So the issue to me has nothing to do with complication. It has everything to do with what we call a complex system. And a complex system is something that has a lot of feedback loops. You do something, it affects me. You know, you're playing chess. You know, every move has a reaction. And it's also very sensitive to conditions and initial conditions in the mathematical sense. So complex systems are things like biology of individuals, of animals, cities, economies, an IT, a technology network is a complex system, an electrical grid. And when these kind of systems undergo a shock, it's really hard to predict what's going to happen because of all the feedback effects. So one of the things I do is I ask people, you know, is this complicated or is it complex? And that has taken me into the realm of thinking about physics, because the physics folks do a way better job at complex systems than the economists do. Next slide. We'll take this a little further. This is the US jobs picture. This is, you see all the jobs lost at the shutdown and then the recovery of the jobs. Next picture. The next one, this is the physics of phase transitions. When you get a network collapse, electrical grid, technology, or in this case, the economy, you basically fall off a cliff, you assess the damage, you have a pretty fast rebound, and then after that, it is much slower and very uneven because you're rebuilding a network, but you can't rebuild it like it used to be. You can never go all the way back. I don't know if any of you read about chaos theory. Back when that first came to my attention was, I think, like around 1990 or something. There was this book about it. A friend of mine told me, Blue, it's really good to talk about it, but don't actually use it. So in the frame of talking about it, chaos theory would tell you that when you're on the top of the mountain and you're deciding to go down that expert ski slope, when you push off, you are not going back up, okay? You're going to find a way down, and one way or the other. And that's what we did with the economy here. We shut it down, and there is an off switch for the economy, but there's no on switch. And so once you're rebuilding, you rebuild very, very differently. So again, to me, we're in the physics of phase transitions. And I didn't do very well in physics in university, but I'm studying it now. Next slide. A couple of things that were going on in the market that I think are important. This again is US data, but it shows what's we really had in the US a drop in the labor force, and people haven't come back in. The participation rates in the labor force are lower than they were before the pandemic. We still have many more jobs to create. We have record numbers of job openings, and we have record numbers of people quitting their jobs voluntarily. It's just an amazing set of inconsistencies if you were analyzing it the old way. So you better find a new framework. Next slide. There is one. Oh, that's the end of our introduction to that section. Erik, I kind of said my piece on the pandemic. What have you learned about how to analyze things, or your main theme of dealing with pandemic analysis?
Well, I think that the main thing for me is kind of going along with your last points there was that things are going to come part way back to some sort of new equilibrium. I don't think that we're ever going to spend full time in the office again. Now that we've all discovered we can work from home. And I think this in some ways feeds into the Brexit topic in a really interesting way. Part of the argument for London while Brexit was, after it had been voted, but before it actually happened, was that, well, you have this gigantic talent pool of workers in London. And that talent pool kind of guaranteed that everybody would stay there because they could exchange employees. They had a sort of liquid market, if you will, for employees. But now that we've all discovered that we don't have to live in the same place in order to do our jobs, you have the potential for a real dispersal of talent in a way that was maybe possible but not imaginable previously. So this has, I think, really profound implications for central cities, for office real estate, for business travel, for commutes to the office and all sorts of other things, but sometimes also for very counterintuitive things. Like people sometimes at the beginning of the pandemic said, this will reduce our carbon footprint, but people are actually now wanting bigger houses. And when they do commute, they drive cars instead of taking public transport. So it may actually be increasing the use of carbon. So it's, I think that there's a lot of very interesting possibilities here that we're still sorting out.
Do we know who the 7 million people who left the US workforce are? Are they?
Well, so just to be clear, there's 3 million who've left the workforce, but there are 7 million fewer jobs. So the US data are very confusing. So so 3 million people. I don't know, Blue. I would guess some of them are people who retired early. Some of them may have decided to stay home to become, full-time parents, but I'm not sure. What are the other possibilities?
Well, we do know, as you mentioned, we've had an unusually large amount of retirements, not just in your average worker, but we're having an above average amount of retirement from the U.S. Senate and the U.S. House of Representatives. Politicians are retiring too. But people are, have reevaluated their work-life balance. And so some people have just decided to retire. Other people are staying home, take care of the kids, take care of family, so forth, because going back to work is still a little tricky in some places. And then there's other groups that we are seeing a fair number of people figuring out how to start their own little businesses. And so they're not counted yet, but that, eventually they will be. And then a lot of the gig economy has taken a pretty big hit. And so, that'll be coming back, but in different ways. So it's really, there's a whole lot of explanations, and there's a lack of data about how to divide them up into each category. But we're running at a voluntary quit rate in the United States at an annual rate of about 4%, and that's usually much, much lower than that. But in certain industries, like say restaurants, but also finance, we're running at much higher voluntary quit rates. I won't steal your thunder, Philippe, but it's also involved with some other types of currencies. So a lot of really different things happening in the underneath the workings of the labor force. And as we said, it's just not going to go back to where it was. I don't like to use the word new normal, because I don't ever think we had so much of a normal. A normal was just what you experienced over a certain period of time that you felt was normal for you. But if you look back over any longer period of history, you can see you get huge changes. And so to me, normal is a fiction of the textbooks in economics. It's part of why economics is so badly taught. Sorry, that's a bias I have that in our book, Economics Gone Astray. Just so you know, a few other biases. Too many economists think linearly, and nothing's linear in economics. Too many economists forget about demography and other big changes because they happen so slowly. Paint does dry, grass does grow, demography changes. So a lot of things economists just don't think about enough in our view. But the pandemic is really going to change that. We're going to have a very different group of economists in the next decade, because this will be what defines what they study. The older economists, you know, the people that are running our central banks today, they're defined by the 1970s. And they're going to be gone, and we're going to have a group defined by the pandemic. So it's going to be a really interesting, different set of policy decisions as we progress through this. Anyway, we'll turn it back over to you, Philippe, for the Q&A and so forth.
Yeah, I'll have a quick. I'll ask you quickly a question to give me time to read the question in the chat. Yesterday, the first Bitcoin ETF was launched in the US after a month of agonizing wait from the SEC's approval. It's replicating Bitcoin futures that list on the CME. Can you give us a few ideas about this product and the underlying futures?
Well, it's an exchange traded fund. It's based entirely on the futures market in Bitcoin. Regulatory rise, it appears that the Securities and Exchange Commission chose that as the first ETF because they like the transparency of the futures markets. It's not an accident that the current chairman of the SEC is the former chairman of the Commodity Futures Trading Commission that regulates the futures market. So, you know, they wanted to go with something that they could really understand, the transparency and so forth. So they chose the futures market as the underlying for the exchange traded fund. But there will be more, and we'll see how that work out. But it had a very, very active launch. And it does signify that the cryptocurrency market is becoming much more institutionalized, which brings in a whole nother set of investors that might not have gone in before, but now they can do so much easier in the exchange traded fund format. So fascinating development for cryptocurrencies.
It was the second most successful ETF launch ever, and I concur, it's probably only the beginning. Maybe we could have a look at the survey results, starting with the one on inflation. All right.
So my question to everybody that answered 3 to 5%, do you own any bonds?
Yeah, the European bond yields are pretty hard to justify if you believe that.
Own a lot of bonds. Sorry. Okay, can we see the next survey, please, Maria-Lise? Okay.
Well, I'm gonna, you know, right. I'll take the other side of this one in the sense that, you know, when you're tired of London, you're tired of life, as they say, or Samuel Johnson said. And I do feel like that London will find a way to come back, and it just depends on how much time you give it. 2023 might not be enough time.
And the final survey on the flying, will we fly again? Wow.
Whoa. That's a short jet fuel thing for sure. I do know that
this jet ETF in the US shorted.
Yeah, it's time to sell the Air France KLM shares, I guess.
Well, you know, that's only the business class cabin. We know that there's a lot of pent-up demand for tourism. But we also know that a lot of companies, having observed the work from home phenomena and how much you can do with a Zoom meeting between different continents, that you know, most companies are cutting back their business travel budgets, but many consumers are planning to fly. So I think rather than my joke about making this a jet fuel discussion is perhaps airlines are going to reconfigure their cabins, and it's going to become a lot more uncomfortable in part of the cabin.
They've started doing it. You're absolutely right. There's a question from Erik in the audience. Do you think we'll have less and less global market integration and more fragmentation? What might be the immediate effects of this? So more integration, more fragmentation when it comes to markets?
Well, I think it's pretty clear we're having more fragmentation. That's my own personal view, is the EU is setting up one regulatory regime. The UK is trying to straddle that into some ways to its own advantage and trying to gradually shift away from that. You have a different regulatory regime in the United States. Then you have a third one coming from China. You probably have a bunch of smaller ones in other parts of the world. I mean, India does its own thing. I can just tell you, as somebody who has US as well as French citizenship living in London, I am in a complete nightmare. No bank wants to take my money because I have US citizenship. Because of PRIP regulations, I am no longer able to buy US mutual funds. I can't buy mutual funds or even our new ETF on crypto, even if I want to, with my own money, even though I'm a US citizen, with my own money in an American bank account because I live in London. So what I see and what I experience personally is fragmentation.
Yeah, and I think we have to be a little careful about the globalization part of this. I don't see less globalization, but I do see it moving around. But if you're a manufacturing group and you, like, say you manufacture clothing in China, you say, okay, I'm going to move that factory to Vietnam. Where are you going to get the cotton? Oh, wait a minute, it comes from China. Where are you going to get the skilled workers? Oh, I have to develop that. The port facilities, are they big enough? Can they handle it? It is not easy to move your supply chains around. And so I think we're going to end up with policies that do mean more diversification within supply chains, but not necessarily less globalization. If you're in the U.S., you might put a factory in Mexico, but that used to be somewhere in Asia. But you're still going to have a lot of your activity outside the country. So I really don't see less globalization, but as Erik said, plenty of fragmentation.
Thank you. One question from Mark Sinsheimer, whom both of you know. If CPI moves up, what happens to asset inflation? Could that pop the global bubble? If you think there is such thing as a bubble, of course.
Yeah, well, I mean, to my mind, I think there are bubbles. It depends on the market. I think some places have real estate bubbles. I would argue the US kind of has a technology stock bubble again. To my mind, inflation is the single biggest danger. If inflation stays low, then you can have low long-term interest rates, which A, make bonds an unattractive alternative, but B, as any CFA society member should know, low long-term interest rates mean that you discount future cash flows very slowly, so they have a very high net present value. If inflation is persistent, then eventually these bond yields have to correct higher. And as they correct higher, the net present value of future cash flows will plunge and bonds will suddenly look very attractive to equity investors. So to my mind, it is the single biggest danger for asset prices.
Yeah, and another thing about this question, it's kind of a loaded question, but thank you, Mark. The bubble in there. My experience is that we can only recognize bubbles in the rearview mirror. When they're happening, they all have good reason. And if you have short-term investment goals, you don't want to exit too soon. So, to me, I don't think we're popping a bubble, but I do think that we are going to see a sea change in central bank policy. Central banks really have a mantra to fight inflation. Now, as I mentioned in the inflation section, I don't think they have the tools to fight supply side inflation, but that doesn't mean they're not going to try. And my conclusion in the US is that the scenario that's most interesting is that they go back to whatever they think is neutral. Now, there is a caution here. Raising interest rates has an issue when there's a lot of debt. So I'm going to flip that to Erik because that's his topic.
Right. Well, Blue, at the very beginning, you said that the Fed ultimately wants to go back to get interest rates back to what they think of as their inflation target, so about 2%. Now, in some ways, 2% seems like it's kind of a reach because we're at zero and we've been at zero for a long time. On the other hand, if you get to 5% inflation, that 2% is actually a negative 3% real rate. But what I think is really remarkable is that debt levels have inflated all around the world. They've roughly doubled over the last 40 years. If you combine the private and public sector debts of Europe, the US, et cetera, they've gone from about 125% to around 300% of GDP over the last 40 years. And so at some point, the only way you can finance these debt burdens is through very, very low interest rates. And so during the 2010s, we basically put interest rates at or near zero. The Fed did eventually get them up to 2 3/8%, but that was really low compared to, say, the 5 1/4 that they got to in 2006, or the 6.5 they had gotten to at the end of the 90s, or the 10% they were at the end of the 80s, or the 20% that they were at the end of the 70s. So we'd been in this tremendous downtrend in interest rates. But now I think central banks are in a dilemma. On the one hand, they have to keep rates low to support the debt burdens. On the other hand, if inflation does start to rise, they have to bring them up at least somewhat. But I think that the end reality is that those high debt burdens make the economy extremely sensitive to small changes in interest rates. So they don't have to hike very much in order to really slow down the economy, which makes that 2% target plausible.
Okay, we have a question from Alejandro Acosta asking whether you see any particular catalyst for the coming big debt crisis. Whether there will be a big debt crisis is another matter, but what could trigger the next big debt crisis? And he asked maybe increasing rates.
Well, do we already have one in China? I mean, are they creating a debt crisis already? I mean, they have extremely high levels of debt in real estate. We're seeing Evergrande, a company that unbelievably has the name Fantasia, both heavily indebted real estate companies that are looking shaky. Chinese credit spreads are starting to widen. I don't think we're going to have a credit crisis in Europe or the US in the short term, but I'm a little more worried about China, because I think you're very right in your question, which is that you typically have to see rate hikes and monetary policy tightening before a crisis happens, but typically at least 2 years, maybe even 4 years before the crisis occurs. So I think Xi Jinping's crackdown on the private sector might be doing the trick in China, but we'll find out.
Yeah, I don't see a catalyst for a crisis in debt. I do see potentially huge volatility in the fixed income market, and some investors are going to have some really bad days and some will have some good days. But in terms of a systematic crisis, I think central banks are going to go so slowly on this that when we have a crisis, if we have one, it'll be a third-party cause that we're not thinking about right now.
Unknown. There has been increased retail investor participation in markets since the beginning of the pandemic. Have you noticed that at the CME, or is it more an equity market, an options market phenomenon?
No, we've definitely seen participation in markets come in waves. The biggest change in the United States, and actually it's occurred in many other places too, has to do with the increased activity of the retail trader. And that's certainly true in the cryptocurrency space and in equity space, not as true in interest rates. Interest rates is a more institutionalized market, but we do see changing patterns. The pandemic, of course, people were working from home and some of them decided to spend their day trading. So that, and we are seeing, changes in what we do with futures market based on that. CME has done a lot of what we call micro products. That's really just offering a smaller size version so that it fits the retail trader a little bit. Not particularly a new idea, since every consumer goods company in the world offers many sizes. But those are some of so the retail trading changing pattern has been the big one. And we'll just follow that. But I will give you a statistic in the on the equity side of futures trading, about 35 to 40% of the contracts traded are the micro contracts versus the full size. So It's a lot of, that's really the big change for a futures exchange. And it's also a big change for equity exchanges. You can take some of the exchanges, the newer ones that are really catered, their business is heavily retail, and of that, it's heavily cryptocurrency. So, you know, those two trends are related.
All right, what other questions do we have? How much of the normalizing goals that was mentioned are attainable by the Fed in monetary policy future, 2% goal, if China continues on the slowdown path it has taken? So China is the child sick at the moment, the sick child at the moment. It's from Mostafa.
I don't think what happens in China is going to be all that important unless it, for the U.S., unless it causes a major global slowdown. I mean, if you've been studying demographics, you knew China was going to be much slower in the 2020s than the last decade and slower than in the previous three. So those 10% growth years are gone, the 6% growth years are gone. And, you know, and what we're seeing now in China is probably just a short-term adjustment to their debt loads and so forth. But China is, unless it causes a huge global problem, isn't going to be an impact on the U.S. Fed wherever it decides to go. And as I mentioned, in the U.S., the people voting on whether to raise interest rates are not the people there today. It's going to be a very different look. And so until we know who they are, I'm going to stay out of that one.
Yeah, I would just add to that in some ways, China's problems remind me a bit of the Asian crisis in 1997, 98. And what happened there was it was a huge issue for Asia, but it actually wasn't really a big issue for Europe and the US. In fact, what it caused was, and this could happen again because commodity prices are very closely linked to the health of China's economy. So it could be a disaster for commodity prices, which could in turn be very bearish for commodity producing currencies like the Aussie dollar, the Canadian dollar, a lot of the Latin American currencies, the Russian ruble. But it could be extremely bullish for the US dollar and the euro. The Asian crisis depressed inflation worldwide, and it allowed the Fed and the ECB's sort of predecessor group of banks to keep policy easier than they might have for longer. So in some ways, it was actually sort of beneficial to the US in Europe. And I think it would also be beneficial to India. They compete with China for natural resources. So if commodity prices plunge, it's kind of a huge relief for India.
Yeah, I think Erik is onto something here in the sense that if you're an emerging market foreign exchange analyst or trader, you can't use that term anymore. You're going to have to divide your countries up into those that import commodities, those that export commodities, and then you're going to need some subgroups about those that are right next door to somebody big, because you've got special risks if you're the neighbor of a big guy. So all of those things are going to change, I think, fairly dramatically how we look at emerging market currencies, and we're going to get a lot more selective.
All right, it's about to be time. I have maybe one final question. Do you have any, how do you view the announced premature resignation of Jens Weidmann of the Deutsche Bundesbank, who was one of the most orthodox central bankers in the world and one of the most hawkish one?
You know, it's so strange. I feel kind of mixed emotions about it. If he had resigned, say 10 years ago, I would have popped a bottle of, I would have bought a bottle of champagne and popped the cork and drunk the whole thing myself. I think that Weidmann, along with Axel Weber, and for that matter, Jean-Claude Trichet, made one of the stupidest monetary policy mistakes I've ever seen when they raised rates in 2010, way before Europe was ready for it. But the irony of it now is that Weidmann might be resigning just at the moment when having a hawk, or at least somebody who's willing to question some of the ECB's crazier ideas like quantitative easing, which to my mind has really no beneficial impact on the economy, and negative interest rates, which is outright harmful, and may in fact be slowing down economic growth rather than supporting it. Seeing him leave now actually makes me feel paradoxically kind of sad. or at least nervous. I don't know.
Okay, so well,
yes, one of the things Erik is quite accurate is that the central bankers do evolve, and you know, they learn. They don't actually, they never admit a mistake, but they do learn and they do change. So it's going to be interesting.
Okay, and I take a final question from Alejandro Acosta about China again. Should we expect inflation in relation to aging population in China? Because if China and Asia have been a deflationist force, maybe this situation will be reversed now?
Oh, that's a really good question, because China and Asia they were a deflationary force because they were providing, they had low wages to produce goods for the whole world. The demographics is very different. We have a larger and larger portion of the population that's retired. We don't have a lot of babies coming up and growing up and entering the labor force. So the labor force in China is going to flatline and then start to shrink. The population will start to shrink after 2025. But I do, you know, my conclusion on this is that an aging population means less demand domestically. But I don't think it impacts China's ability to supply the goods the world wants. It's just that their wages have gone up over what they were 20 years ago. They're still highly competitive, but that will erode. So the deflationary impact from supplying the world with goods will diminish, but we'll get some deflationary impact domestically in China, but also domestically in the European Union, in France and Germany, and in the US, in Korea. We've already seen it in Japan. You'll have a lot of people stop talking about GDP, and then they're going to start talking about GDP per capita, because you're going to need to understand that if your labor force isn't growing, the only growth comes from labor productivity. And so like on a decade basis, that's a 1.5% number. You're going to have to get used to a lot slower real GDP growth, but on a per capita basis, you might be doing all right. So that's definitely a two-pronged question with two different answers from one economist.
Thank you. So we'll conclude today's webinar. I thank you, both of you, very much for your insights, and I thank the audience for listening and asking questions. I wish everybody a very good, a very pleasant evening, and please answer the post-event survey that Marie-Alix has just posted on your screen. And I hope you were as interested in this webinar as I was. Thank you all. Have a very pleasant evening, and see you soon at one of CFA Society France's webinars.
Merci. Bonne soirée.
Bonne soirée.
Bonne soirée.